All right, so let me introduce our next speaker from the Washington Update, Jeff Bush. Jeff's a dynamic, insightful speaker and author. Jeff is known for his unique ability to translate difficult and confusing tax and fiscal information coming out of Washington, D.C. into winning growth strategies for business owners, executives, and high net worth investors. Jeff is a colleague of Andy Friedman and an integral part of the Washington Update, the industry's nonpartisan experts on all things Washington. In the 2012 presidential election, Jeff accurately predicted the outcome 14 months in advance, as well as predicting the Republican sweep of Congress in 2014. Jeff also predicted the fiscal cliff outcome that led to the single largest tax increase in dollar terms in U.S. history. This advice gave professional advisors and clients an opportunity to prepare for the political changes that would impact their bottom line. Jeff presents more than 200 times yearly. That's impressive. In the U.S. and abroad, a client base that includes the who's who of list of Fortune 500 firms from Wall Street to Main Street and everywhere else in between. Jeff is a 28-year veteran in the financial industry. By the end of his career on Wall Street, he has managed $50+ billion in sales. Before that, Jeff was the youngest managing partner in the 150-year history of the New England Financial. Jeff is considered Wall Street's Washington insider, and politically speaking, Jeff is known for being America's foremost equal opportunity offender. So I know a lot of us have leveraged Andy Friedman before in the past. We did a couple of webinars this year. I think we're at a point in this country's history, both politically and from an economic standpoint, where the more insight, the more tools, the more material that we have to make informed decisions and to better leverage the conversation we have with advisors is absolutely integral to our business. So please welcome Jeff Bush to the stage.
I think Graham started today and said he really was passionate about comedians, so I'm a little bit curious as to why you hired a tax and political guy. But we are going to try to have a little bit of fun. I assume everybody has seen Andy or me present before, so I'm going to just jump right into our discussion today. We only have about 45 minutes together, and as you know, normally we can drone on for hours and hours. So if we're going to talk about 2016 and 2017, I thought it would be helpful to just do a real quick reminder on what took place in the election last year. Not from a perspective of what happened, we all know what happened, but more importantly, I want to spend a couple of minutes and talk about why the 2016 election went down the way it did. But then we're going to spend the mass majority of our time talking about the cornucopia of agenda items that the Donald Trump administration has started to put forward. And then we're going to end our time today talking about an interesting inflection point that I think uniquely annuities are poised very well to succeed in moving forward. So if we're going to talk about the election, it really was an election of known and unknowns. And what I mean by that is going in, we knew about the Donald Trump supporters. They were obvious. They were standing in 3-hour lines to go see Mr. Trump in those campaign rallies. But what we also knew about 2016 is that it was a change election year. We also knew that Hillary Clinton was anything but a change candidate. But I think 2016 was much more defined about what we did not know going into that election. What we did not know was that the Obama coalition was just that. It was the Obama coalition. It is not the Democratic coalition. Whether you look at millennial voters, African American, Latinos, Asian Americans, consistently down the line, the Democratic ticket way underperformed President Obama back in 2012. But I think the more interesting unknown about 2016 was the second Republican that decided to show up on Election Day. Again, we knew about the Donald Trump supporter, and if you waited 3 hours to see him in an unheated hangar, you were definitely going to show up on Election Day. But the second Republican voter was much more interesting. That Republican voter showed up to make sure that a President Hillary Clinton had to deal with a Republican Congress. And what I mean by that is they were there to make sure that they voted for their Republican Senate candidate as well as their Republican House members. But while they were there, they certainly weren't going to vote for Hillary Clinton. And they went ahead and checked the box for Donald Trump. Fully 90% of Republicans showed up voting in line for Donald Trump. And that really was the unknown element of 2016. Now, there was certainly a geographic element of 2016 as well. Hillary Clinton consistently underperformed President Obama across the entire country, except in 2 geographies, South Florida and South Texas, both heavily Latino areas. But what's interesting is, if you look at the other side of that table, is that Donald Trump also overperformed Mitt Romney in those same two geographies. But 2016 was all about that industrial Midwest story. And again, we're not going to belabor that. We don't have time today. But what I want to spend the majority of our time is talking about these legislative agendas that Donald Trump has put forward. As I mentioned earlier, he has given us a cornucopia of things to talk about. But there is also a reality that we need to understand. Yes, the Republicans control the House, the Senate, as well as the White House, but there are two checks on any runaway Republican agenda, starting with the Senate filibuster rules. As you know, in the Senate, it takes 60 votes to override a presidential veto, and the Republicans only control 52 seats. Therefore, they can't simply pass legislation as they see fit. They'll have to deal with that 60-vote filibuster minimum. Now, there are two approaches the Republicans could use. They could bust the filibuster, not unlike Harry Reid did back in 2014 when he lowered the threshold in the Senate to 51 votes for presidential appointees and federal judges. But even Harry Reid didn't lower it for Supreme Court judges or legislation. Both of those need to still meet that 60-vote threshold. We do not believe the Republicans under Mitch McConnell would lower the filibuster minimum for legislation to 51 votes. And the reason is very simple. There is an element of history or appreciation for the traditions of the Senate. The Senate was always meant to be a deliberative body, and therefore if you can't convince 60 Americans that it's a good idea, maybe it's not a good direction for our country. But what's more interestingly than that, and a word that you're going to get absolutely sick of hearing between now and the next couple of years, is the word reconciliation. Now, reconciliation is one of those words that means something very different inside the Beltway. You see, you and I, when we hear the word reconciliation, we think two people who have an honest disagreement sit down, they talk about their differences, and then they come to some workable solution. But that's not how reconciliation works within Washington, D.C., and certainly within the Senate. It works much more like it does in my own household. When my wife and I have a disagreement, we sit down, we talk about our disagreement, and I quickly realize within 1 minute that she was right all along and we do what she wants. And of course, in this situation, my wife is playing the part of the Republicans. You see, for reconciliation, you only need 51 votes. Now, 51 votes is easy for the Republicans to achieve considering they have 52 Republicans, assuming they can hold that group together. I think that will be the bigger challenge for them. We'll see that play out in several different scenarios. I think most appropriately and most early will be around the repeal of the Affordable Care Act. But in addition to that, there's another check against a runaway Republican agenda. And what I mean by that is that the Republicans have a group of Republicans called the GOP deficit hawks. There are lots of Republicans in Washington, and certainly the majority within the House of Representatives, that have run consistently and multiple times on being a fiscal conservative. They don't want to do anything to grow the debt, grow the deficit, and so forth. So I think those fiscal conservative Republicans will also have a little bit of a check power against a Donald Trump presidency. We're seeing again that play out as we start talking about the budget reconciliation moving forward. Now, I do want to make one thing very, very clear. That word reconciliation, that process can only be used for budgetary items. So budgetary tax items, penalties, things like that, anything that affects that budget and deficit can be impacted by that reconciliation process. So with that as a backdrop about what can get done in Washington, D.C. and how it might get done moving forward, let's talk about some of these agenda items, starting with trade. We know Donald Trump ran on America First platform, but that's not where the Republicans have been all along. The Republicans are much more of a free trade type of platform party, and those two things necessarily conflict one another. Now, Donald Trump talked throughout his candidacy around putting tariffs and trade protectionisms and so forth on these countries that he deemed challenging to our exports in our economy. The real question is, what kind of authority does a president of the United States actually have around these trade tariff issues? Well, there are very few powers solely invested in the president of the United States, and one of them happens to be trade tariffs. So to the extent that a president believes there's been currency manipulation or to protect a U.S. industry or the U.S. national interest, they have all the power they need as president of the United States to put those tariffs in place. Now, the net effect of the United States, should Donald Trump go ahead and put some of these tariffs on imports coming into our country, would be what? It would be increased consumer prices and increased inflation. I think trade is the one area that I'm most concerned about as we navigate this very thin line about economic growth, but also fiscal stimulus, of how to get that balance right. Trade could be the one wild card that throws that balance out of whack. Now, in addition to that, we also know we need to talk about the Affordable Care Act. That's the one thing the Republicans are teeing up most quickly here. And the Republicans have run consistently, as well as Donald Trump has, on repeal and replace. Well, right now we have yet to hear a solid, complete, thought-out replace plan by the Republicans, but that didn't bother the Republicans. They wanted to go ahead and repeal the Affordable Care Act. Well, that energy is really starting to heat up, and we're already seeing a lot of Republicans backing off the idea of repealing the law until they can tell insurance companies and insureds what that replace plan is. Besides that, any type of law like the Affordable Care Act meets that filibuster challenge. In other words, you have to count on 60 individuals to actually repeal the Affordable Care Act. That means 8 Democrats, assuming the Republicans can hold their caucus together, would have to go along. And I'm not saying that's impossible, I'm just saying it's very unlikely. I think the most probable path for the Affordable Care Act is to actually get the law from within using reconciliation. That 3.8% tax that pays for the Affordable Care Act, that could be done away with reconciliation. The penalties associated with the Affordable Care Act, that could be done with reconciliation, as well as the subsidies for the insurance and insureds and the insurance companies. You know, we've heard a lot about the premium subsidies to low-income families, right? The premium subsidies that literally lower the cost of their health insurance premiums. But how many of you knew there's actually a second set of subsidies within the Affordable Care Act? Those second set of subsidies go directly from the federal government to the insurance company to artificially lower lower-income families' deductibles and coinsurance. You probably notice here at AXA your deductibles and coinsurance going up, right? And that's been as equally impactful as increased premiums. Well, these low-income families, they haven't experienced that because of those subsidies. Now, one of the most insidious things inside the Affordable Care Act is those families receiving those offset subsidies to lower their out-of-pockets and deductibles have no idea they're getting that subsidy. That subsidy goes, as I mentioned, from the federal government to the insurance company, and therefore those families are completely unaware that their deductibles and coinsurance are artificially low. That could really throw a wrench into that repeal type of program. Now, along those same lines, though, there is a lot of significant agreement between the Republicans and Democrats around health care reform. When you take a Republican out and give them a couple of cocktails and say, what do you want to do with the repeal process? They'll tell you they want kids to stay on their parents' plan until they're 26. They want to make sure that no American is subject to pre-existing conditions and accessing health insurance coverage. And for the most part, they also agree there should be no lifetime maximums to health insurance coverage. Well, you and I know we're basically junior actuaries in this business. Those are the 3 primary tenets of the Affordable Care Act. They're also the 3 most expensive parts of the Affordable Care Act as well. So Republicans agree that there should be those basic tenets of the Affordable Care Act kept in place. Not that they wouldn't make any changes, they absolutely would. They would allow insurance to be sold across state lines. The idea there is that more competition drives down price. In addition to that, they also would like individuals buying their health insurance coverage on the exchanges to be able to take a tax deduction or get a tax credit for those premiums paid. After all, you as a part of AXA, you get to pay your health insurance premium pre-tax. Why doesn't an individual get that same option? And then finally, they would also like to expand the use of health savings accounts. Obviously, to get more competitive health insurance premiums, we're looking at larger deductible plans to drive down that premium. Therefore, HSAs would be enhanced to allow families to save up for those unintended medical bills. Now, when we talk about the financial platform of Donald Trump, you have to deal with a bit of a yin and yang that is Donald Trump. What I mean by that is we know he ran on a pro-business platform, deregulation, decreased taxes, and et cetera. But what he also ran was on a populist platform. And so in order to look at the financial regulation, you really need to understand both sides of that equation. And there are two primary issues that we're focused on. That's Dodd-Frank and DOL. Dodd-Frank, being a piece of legislation, would have to deal with the legislation part via the filibuster minimum. So how many of you think that 8 Democrats will vote to repeal or get rid of the Dodd-Frank? Yeah, I didn't think so. Neither do we. We don't think that's very likely. Where we do think the Trump administration could go make an effort to water down the effects of Dodd-Frank is with that Consumer Financial Protection Board. What he could do is simply underfund the department's ability to enforce or to fund that Consumer Protection Board. He could also change the way we nominate and put forward the head of that protection board as well, therefore making them subject to congressional either approval or hiring and firing of the president. That would also work to degrade the impact of that role. Now, the DOL is a little bit different. As was talked about with Todd, the DOL is actually a regulation, not a law. And under a final regulation, you have to deal with that in a little bit different way. You could go through the entire regulatory process again, but we only have until April 10th. So there's no way you could go through that full regulatory process and get that accomplished by April 10th. You could also expect the legislature to put forward a bill, and ironically, they did this week. I agree with Todd, though. That is not going to go anywhere in this legislative environment. Now, you could also count on the judiciary. In other words, these lawsuits that are working their way through the courts, a Donald Trump president could simply instruct the Department of Labor to not defend the state's position. If you don't show up and defend your case in court, what happens? The plaintiff wins. So they could do that through a somewhat passive type of an approach. But I want to see a show of hands. How many of you think that more passive approach, does that sound like Donald Trump that we know and love? No, I don't think so either. I think what's more likely, to the extent that there is action around the DOL, will be around a presidential interim financial reg, or a final reg. And what I mean by that is the President of the United States could simply issue an interim final reg that tells the Department of Labor is, hey, hold on, we're going to start this entire regulatory process again and redefine the DOL fiduciary standard. So knowing that and expecting that process to take some time, we're going to delay the effective date. Now, Todd mentioned that most pundits are more optimistic than not. I hope I'm not putting words in Todd's mouth, but more optimistic than not. I'm not exactly there yet, to be honest with you. And the reason I'm not is that we have no idea whether this is a priority for Donald Trump or not. We've never heard Donald Trump mention DOL in that succession throughout his entire campaign. So we just simply don't know. But bottom line, if it is a priority for Donald Trump, he does have the opportunity to address that via one of these methods. Now let's kind of move on. Let's talk about tax and fiscal policy. That's a core issue that Donald Trump has put forward, and the beginnings of that started last night. Donald Trump and his advisors met with the congressional leaders, Paul Ryan and Mitch McConnell, to start that dialogue of where they want to take tax reform. Now, in order to understand that, I want to take a little bit of a step back and give you a history lesson, or at least remind you that the conversation around tax reform completely changed with this election. Previous to this election, the dialogue from the Democrats was that tax reform should increase federal revenues. Republicans were saying, no, Democrats, you have it all wrong. It should be a revenue neutral exercise. Well, that's not the new dialogue, is it? Donald Trump is saying, no, tax reform should actually reduce federal revenues, and the Republicans' position is still that they want revenue neutral. So that's the new debate moving forward, whether tax reform decreases revenue or goes for revenue neutrality. Now, it is important to understand that in any effort of tax reform, there are by definition winners and losers. You cannot go through tax reform and not have that. Why we have a little more detail around the position of Donald Trump and the Republicans right now is they coalesced this past summer. And Donald Trump basically came to where the Republicans are in their new way forward type of program. They put forward that there should be 3 tax brackets for both income as well as capital gains. And they agree on those basic tenets. But when you get into the granularity of the tax code that we need to understand, that's where you and I make our living. While yes, there's certainly going to be lower marginal rates, that's where Donald Trump is taking us. There's no doubt about that. They also want to get rid of the 3.8% Affordable Care Act tax. Remember, they're going to repeal the Affordable Care Act, so why do they need the tax to pay for it? In addition to that, they also want to eliminate the alternative minimum tax. After all, if you've gone through tax reform process, why do you need an alternative way to calculate your tax liability? Hopefully, through tax reform, you've come up with the right way to do it. Now, in addition to that, we also know that Donald Trump wants to repeal the estate tax. Before you get excited, though, it's going to work a lot like it did back in 2010. Back in 2010, that glorious year, if you remember, where every good client should have killed themselves to avoid estate taxes, they also lost stepped-up basis. What Donald Trump is suggesting is that, yes, we eliminate the estate tax, but stepped-up basis goes away as well for families over $10 million net worth. So that's to be hammered out. There's a lot of details there and subtleties as to where that line of embarkation could come from. In addition to that, interestingly, Donald Trump has put forward the idea that for wealthier Americans, the tax-deferred buildup inside life insurance should no longer be an option. Now, that in and of itself is fraught with all sorts of difficulties in how you administer that. Let's say they make that line $1 million of MAGI, modified adjusted gross income. Well, this year, lucky me, I made $1.1 million, so I lose tax deferral on my life insurance. But then next year, I don't have such a great year. I only make $998,000. Now, do I get it back? And so you can see that there are just challenges anytime you set hard lines like that with tax policy. This also begs the question, if they're making that same commentary around life insurance, will our annuities soon to follow? It seems logical that you would tie those two things together. Let me give you a little bit of a good news. We do not believe that would likely to move forward. That was a placeholder in Donald Trump's tax policy. And you and I both know that our PACs, our super PAC, our PACs, are very effective in Washington, D.C. about educating elected officials on the value of these products and helping people save for their own retirement. There are a couple of things in Washington that are broadly held as sacred cows, if you will, and one of them is the absolute terror that Americans aren't saving enough for their own retirement. To the extent that the insurance lobby has been successful in helping elected officials understand the value of annuities and life insurance and helping people save for their own retirement, I think that will protect them from some of the wrath inside this tax policy. Again, we don't think that's likely to move forward. But our dialogue gets a lot more interesting when we start talking about corporate and businesses. I realize a lot of people that you work with directly own their own practice, and certainly their clients are primarily business owners. What Donald Trump would do is lower the maximum corporate tax rate from the current 35% all the way down to 15%. More interestingly, he would apply that to pass-through business owners. I imagine a lot of your clients, certainly in the independent space, own their businesses or as LLCs or sole proprietors or S-corps. That means their maximum tax bracket would now be 15%. That is a huge change within corporate tax policy. Obviously, one I would personally welcome. Now, one area that Donald Trump completely disagrees with where the Republican position is on what direction we should go from a philosophical perspective in corporate taxation. You see, Donald Trump wants to move to a worldwide tax system, and the Republicans have said all along that they want to move to a territorial tax system. Now, quick show of hands. You want me to spend 2 minutes and explain what that is? Yes? Yes? Okay. Worldwide tax system, the direction that Donald Trump wants to go, tells Apple, hey, Apple, good for you for selling that iPhone in Australia this year. I know you made a little profit on the sale of that phone. Good for you. Do whatever you want with that profit. Leave it in Australia, take it to Ireland, bring it back to the United States. It doesn't matter. Because you're a U.S. domiciled corporation, you're going to pay U.S. taxes this year. Now, the Republicans, on the other hand, the territorial tax system tells Apple, hey, Apple, good for you for selling that iPhone in Australia this year. I know you made a little profit on the sale. Good for you. Do whatever you want with that profit, but because you earned that profit in Australia, you will never pay a U.S. tax on that profit. So you can see the Republicans and Donald Trump are in complete polar opposites in the philosophical direction of worldwide taxation. Now, what Donald Trump would also suggest, and the Republicans agree, is that immediate expensing should be allowed for business owners. Let's say I own an earth moving company and I need to buy a new bulldozer. If I buy a new bulldozer today, I have to depreciate that asset over its useful life. What immediate expensing allows me is gives me a choice to fully write off the value of that bulldozer in the year that I made that purchase. Ladies and gentlemen, that is a huge opportunity to get capital out from the pockets of our business owners in buying these capital goods. That's an area in corporate taxation that we think would be the most likely to be very stimulative inside this Republican tax proposal moving forward. Now, have you heard about those corporate earnings sitting offshore, not ever being taxed in the United States? We've heard as much as $2.5 trillion is sitting offshore, not being taxed in the United States based on our current tax situation. What Donald Trump would suggest is that we immediately tax those offshore earnings at 10%. Now, quick math, that's $250 billion. Quick show of hands, how many of you think $250 billion is a lot of money? Anyone? Well, why don't you come to Washington with me, and I'll tell you how small a bucket $250 billion is. As a matter of fact, $250 billion is less than 1/2 of 1 year's annual budget deficit. So it will not fundamentally change the trajectory of our country. And I'm not saying we don't do it. I'm just saying keep it in perspective as to what that bucket, or how big that bucket really is. Besides, don't get too excited thinking you might get a little bit of an extra refund. That money has already been allocated by Donald Trump. He's already spent that money. And I'll talk about that here in a moment. Carried interest is a no-brainer. Once we enter tax reform, Democrats and Republicans both agree that carried interest should be taxed at ordinary rates. So go back to our original question. Does tax reform generate less revenue for the federal government, or is it revenue neutral? If it's to the extent that the Republicans, those Republican deficit hawks, force a discussion about revenue neutrality, these are the big buckets that will have to be filled. And ladies and gentlemen, these are large buckets. Even the most optimistic planning says that the Donald Trump's tax plan and the Republicans' tax plan would add $3 trillion in additional debt above what we're already projecting over the next 10 years. So that's that revenue neutral bucket that you're going to have to try to plug at minimum. Now, that's the revenue side, but what about the spending side? Well, Donald Trump has put forward the idea that he wants to build up defense dramatically, and that's a great fiscal stimulus. But in addition to that, he has a big jobs program as well. Remember that $250 billion that I told you don't get excited about because Donald Trump already spent that money? He spent that money on this jobs program. You see, Donald Trump wants to invest an incredible amount of money in our infrastructure redevelopment. He's mentioned as much as $1 trillion using tax credits to partner with private firms to rebuild our infrastructure in the United States. So that $250 billion is a way to help fund those tax credits. Bottom line is we're adding debt much faster than we had projected. And let me just let you in on this fact. This number that I'm showing you here, that publicly held debt as a percentage of GDP, is projected to reach 85.5% by 2026. Ladies and gentlemen, this is before that extra $3 trillion I mentioned a moment ago. Meaning we're adding debt much faster than we had originally projected. And while I appreciate the CBO, the Congressional Budget Office, providing this graph, I think they're really taking a narrow view of that reality. I wanted to take a little bit longer perspective and say, well, what does that really mean? Because this graph somewhat makes you think that middle 70% is normal. Ladies and gentlemen, it's far from normal. Ladies and gentlemen, we're already twice the long-term debt to GDP average. The long-term average is about 38%, and we're already at the mid-70s and trending the wrong direction. You see, there's just this fundamental disagreement in Washington where Democrats believe that capitalism, by definition, favors the wealthy, and that the federal government has an active role in redistributing that wealth. Active is the key word. The current modus operandi of the Democratic Party is the redistribution of that wealth should be based on the progressivity of the U.S. tax code. In other words, wealthier Americans should share disproportionately in any tax increase. Now, Republicans quickly retort, don't they? They say, Democrats, you have it all wrong. It's all about economic growth. Anything that we do as a government to overburden job creators or wealth creators only thwarts that growth. We need to be backing ourselves out of that economic equation, i.e. lower taxes and lower regulatory burden. Well, clearly the Republicans won this philosophical argument in this last election. We are definitely heading towards a lower tax rate environment. That's a given. I like this chart. It shows the long-term, or the modern, if you will, 1913 to today, the long-term highest marginal tax bracket throughout U.S. history. Now, I'll come back to that in a minute. Just know that we're heading to a lower tax rate environment under the Republican and Donald Trump tenure here. Now, in my humble opinion, advice has never been more vital than it is today. And what I mean by that is we defined value before as asset allocation. I think that's gone. Asset allocation has to be married with the right asset location. Asset location is based on a client's unique tax situation. Let me explain what I mean. I'm a 50-year-old guy. Let's say I make $300,000 a year. My advisor has another 50-year-old male client making the same $300,000 a year. Now, we both have, there's only one difference between these two clients. I own my own business. That client's a W-2 employee. Now, we both have 15 years until retirement, so we should have roughly the same asset allocation, right? Allocation's about time frame. But if my advisor has us in the same asset location, he's committing malpractice. He's committing malpractice because our tax realities are so completely different, and our portfolio should reflect those differences. That, in my opinion, is value moving forward. And it plays right into my concept of managing asset volatility has been the goal in years past, but we've made a science out of that. Computers do that now. Moving forward, it's about managing tax volatility, certainly for higher income, higher net worth people. And when I retire, I subscribe to what I call my 3-bucket strategy. When I retire, I want 3 equal buckets of money: a bucket of tax-free, a bucket of taxable, and a bucket of tax-deferred. I tactically fund those buckets based on my tax reality for that year. Now, along those same lines, though, the opportunity there in funding those 3 tax buckets is I fund them based on that tactical tax year, but I also am looking forward. I also know that I'm going to spend 30 to 35 years in retirement. Here's the little naked truth that we can't answer today. The reality is, if a client spends 30, 35 years in retirement, we have no idea what their tax liability will be during that time frame. You tell me what 30, 35 years your client will spend in retirement, and I'll tell you exactly how to invest today. But the reality is you don't know, and I don't know, and they don't know. What that means is there is value created by having a myriad of income generation opportunities in retirement so that we get to manipulate the tax code for our lifestyle rather than the tax code tell us what our lifestyle will be. One of my biggest concerns for the average American is what little they have saved, or let me say it this way. If an American who's done a really good job of saving for retirement, where is 100% of their retirement savings? 401k IRA. One tax strategy when they retire. Their tax rate, that volatility in tax rate, will tell that individual what their lifestyle will be. Ladies and gentlemen, I am not going to give the IRS that kind of power over my retirement, and I imagine you don't want them to have that power over you as well. We're heading to a lower tax rate environment, which really means that I'm going to slow down the funding of my pension plan and increase my after-tax savings, all in an effort to diversify my sources of income generation and retirement, giving me the flexibility rather than the IRS the power. Now, along those same lines, as an industry, we've done a really poor job of long-term care planning. We made a major mistake back in the mid-90s when we started talking about long-term care planning. Not that we shouldn't have talked about it, we absolutely should. The mistake that we made is that it should have been a part of a retirement planning process. You and I both know that 1/3 of retirees will experience a long-term care incident during their retired years. We know it's a big ticket item. And if something is as likely to impact 1/3 of retirees, then by God, 100% of clients deserve a long-term care plan. Would you not agree? And should that plan not be a part of their retirement plan? Now, correct me if I'm wrong. We have some solutions in that space. And I think that's a growing part of the discussion we need to be having with clients. It may be uncomfortable for a lot of our advisors to have that conversation with their client, but you cannot be in a fiduciary world talking about retirement planning without talking about long-term care. Now, more tactically than that, and I know we don't necessarily invest our money tactically, but to the extent that you are invested in fixed income, I certainly would be shortening the duration and the interest rate environment right now. But then, interestingly, rarely do we actually project winners and losers in the current environment. But we're at that interesting inflection point that Andy and I thought, you know what, we can really define who's likely to do well and not as well in these future environments. So let's talk about that real quickly. We know, for example, that domestic industrials with that immediate expensing as well as the buildup of the defense and infrastructure will be a big boom to that domestic industrial environment. In addition to that, traditional energy under Donald Trump should do very well. Donald Trump has all the authority he needs to open up federal lands, offshore drilling, connect the unbuilt ends of those pipelines across our country, and I fully anticipate if price supports it, it will be a very positive thing for traditional energy. Defense will do well, obviously, with the buildup, but also that immediate expensing. Obviously, building defense equipment takes a lot of heavy equipment quite often. I think financial services will do very well. Obviously, with the increased interest rates, that's taken an opportunity for a lot of our financial firms to get a breath back and so forth, but also that lower regulatory environment. And then in addition to that, consumer discretionary. If we do move to a lower tax rate environment where the middle class and lower income families get more money in their pockets, what does an American do when they have a little extra change in their pocket? They spend it. So consumer discretionary should do well in this environment as well. Now, a couple areas I would draw your attention to. Now, I'm not saying it's completely negative. I think it's mixed for both of these companies. But one is technology. I know they've been on a tear since the election, but once we get into tax reform, to the extent that we move to a worldwide tax system, as Donald Trump wants to move, that will be a major challenge for our technology companies. You see, our technology companies have been the absolute kings and queens of moving those earnings offshore and keeping them out of the U.S. tax system. To the extent that we move to a worldwide tax system, even if it goes down to as low as 15%, that would be a huge tax increase for a lot of technology companies. In addition to that, though, on the pharmaceutical and healthcare front, this is where it's definitely a big mixed bag. Obviously, if the Republicans repeal the Affordable Care Act, and there are less people insured, that will be a challenge for the insurance companies. And the healthcare providers, there are less people who can afford their services. A challenge for the pharmaceutical industry is one thing that Donald Trump has talked about, is lumping together Medicare for pharmaceutical negotiations. How many of you know that Blue Cross Arizona and Blue Cross New Mexico and Humana Arizona and Humana New Mexico all have to negotiate their pharmaceutical deals separately? Did you know that? Even though they're all providing Medicare insurance coverage. What Republicans and specifically Donald Trump want to do is say that's really stupid. We're going to aggregate every Medicare patient in the United States and then go to the drug companies and negotiate those prices. Well, you can imagine that's a tremendous leverage opportunity for the federal government. To the extent they're successful in doing that, and we actually have a model where they have been successful in doing that, that will be a real financial challenge for pharmaceutical companies. The successful example of that is Medicaid. The cheapest provider of pharmaceuticals within the U.S. marketplace is Medicaid. And the reason why is they negotiate nationally. And Donald Trump wants to take advantage of that for Medicare. Now, that deregulation type of mindset behind Donald Trump and the Republicans should also be a positive in that pharmaceutical space as well, just because it should speed up the FDA regulatory process. So with that, I would be very much more interested in what's on your mind. You're talking to advisors and clients every single day. I'm sure you're getting a lot of questions, and I brush through a lot of these things very quickly, but we can get into as much depth as you want. So please, if we can bring up the house lights, let's see what questions you have, and I'll just repeat them for the remainder of the audience. Anyone? I know this didn't go well earlier, Graham. We'll try it with me. Yes, sir. Yeah, great question. I glossed over that a little bit too quickly. I apologize. So the challenge is this. If the Republicans are successful in getting tax reform done this year, which we believe they will, they'll have a choice. They could make that a Forward-looking change, in other words, starting January 2018, they could backdate it to January 2017, or they could do a hybrid of that, where they go back to 2017 and they blend the two rates. So if use easy numbers, if you're at a 40% marginal rate and going forward you'll be in 20, they just simply blend it for 2017 and say you're in 30. So that certainly could be the option moving forward. No one knows. Our gut tells us they're going to want to backdate it. Donald Trump is going to want to get as much money in the marketplace as quickly as he possibly can, keeping in mind that business owners like me, I won't be filing my 2017 taxes until when? September of 2018. So he's going to want to get the money in the market fast as he can, so I think it'll be backdated. It probably will be a blended backdating, but backdated nonetheless. Yeah, great question. Yes, sir.
Back to your tax cuts, going to revenue neutral, we're probably going to have to eliminate some deductions if they're going to go to the three tax brackets. So you're going to see a lot of deductions go away, so your effective rate is going to be right where you were anyway.
Thank you very much. So the comment was, if you go to three marginal rates and you do all these other tax changes, to the extent that you try to make this revenue neutral, you're going to have to eliminate a lot of tax loopholes. Now, another name for a tax loophole is tax deduction. Ladies and gentlemen, don't forget that it was the Republicans that suggested that maybe your mortgage interest rate deduction should be more limited. Maybe you should not be able to get full, if you're a higher income individual, full write-off of municipal bonds or tax-free status of municipal bonds. Don't forget it was Republicans that suggested that, this is for our New York, Connecticut, New Jersey friends, and California friends, is you should not be able to write off your state and local taxes. Those would be big tax increases. So bottom line is, the question is, through tax reform, where do we end this process in an effective tax rate analysis? At this point, we don't know. We don't have enough details to actually know where we're going to end on the effective tax rate basis. I'm here to tell you it's going to look a lot more like it does now on an effective rate than some wholesale revolution. Yes, sir. Oh, sorry.
Your slide on your three buckets on the deferral, you're expecting to go to the 15% bracket as a self-employed person.
Right.
So you're shifting from maybe going into a DC-DB combo to a after-tax, tax-deferred bucket for long-term accumulation, and then projecting maybe tax efficiency on the back end.
Exactly. My goal in those three...
So Roth conversions are going to be up, possibly also what we're looking at, Graham, with our IE distribution plan.
Absolutely, yeah. So when I talk about those three buckets, I try to explain it. I tactically look for opportunities to fund those three buckets, and I've been overfunding my tax deferred through my pension plan. But if those tax rates go down, and now I'm subject to a 15% rate, even if it's a 20% rate, I'll be looking to do more after tax and start working on those buckets for a few years.
On the accumulation phase, right?
Say again?
So for the next 20 years on the deferral.
Right. Well, I'm going to fund deferred product, and I'm going to deferred straight taxable product, fund up my brokerage account as well.
Great.
So both.
I'd like to talk to you about lunch. We've got a solution for it.
Good. I wonder if I was being led somewhere. Yeah. I don't exactly have a ring in my nose, but yeah. Hey, Larry.
Hey, Jeff. There's been a lot of talk the last 5 years that effectively, stretch IRAs, life expectancy distributions to non-spouse beneficiaries were going to go away.
Right.
Do we see that in this administration even being on the radar? Is it something that's not probably going to get pushed aside and probably not going to happen anytime soon?
Stretch IRA is on the radar. It's not being as actively talked about as it was a year and a half ago, but it certainly is on the radar. Again, the Republicans, I think the deficit hawks are really going to push the Republicans to try to be more revenue neutral, and they're going to look for more esoteric parts of the code to make that happen. What I mean by an esoteric part of the code is a part of the code that's a little bit more complicated, a little more high-end, i.e. affect high-end or higher income individuals. Why they would go after the stretch is that only wealthy people stretch. Certainly wealthier children are the ones that actually take it over their lifetime rather than cash out. Yeah. So I think that will come back on the radar as well. Mm-hmm. Who gets the cube next? Yes. Yeah. I would not anticipate. So the question was, what about undistributed income and trust? Do we anticipate that would still stay at the highest tax bracket? The short answer is yes, and the reason why is that revenue neutrality perspective. That's an esoteric part of the code that's taxed automatically at that highest rate. But keep in mind that highest rate may be a lot lower. So there's still an advantage there, or a better situation than we're in today. Yeah. Yes, sir. Yeah. As far as the Affordable Care Act repeal and replace and the timing of that, I think the Republicans, I know this has been overused in the media, so I'm apologizing, but they really are the dog that caught the bus. And all of a sudden now they have the opportunity to actually repeal the darn thing, and they're like, oh crap, now we got to come up with plan B. They have wasted 6 years in not coming forth with what they believe a plan would be. Their challenge is one of marketing, and so maybe our industry could help them out a little bit. It's marketing because they have so couched themselves on repealing the Affordable Care Act, even though they want to keep the primary tenets of the law. So now they have to repeal what's called the Affordable Care Act and come up with whatever they want to call their plan. But interestingly, it will still maintain those three tenets. My gut tells me that they are not going to be successful in actually repealing the law without a replacement. I think it will likely get kicked a little bit. What we're hearing right now is that maybe even 3 months. They're really trying to bite off a lot of these things right off the bat. They've got tax reform kicked off last night, and earnest effort in kicking that off last night. So my gut tells me they're going to buy some time here. They've got to be able to tell insurance companies and individuals what they can expect out of that law. Right now, you can't even get the Speaker of the House to commit to the idea that everybody who has insurance today will be able to keep what they have. And that's a problem. I think I remember President Obama getting himself in a little trouble that way as well. So, anything else? Okay, real quickly then, let me wrap up. I appreciate your time today. But you can keep up with what Andy and I are talking about on our website, thewashingtonupdate.com. You can go onto our website and hit the subscribe button and sign up for our free updates. As the name implies, they are free, no-cost items, and there are many white papers that we'll send out eight of those a year or so. This is going to be a very active year as we move into the repealing the Affordable Care Act as well as tax reform and the like. So I really encourage you to sign up. Again, there's no charge for it. In addition to that, more tactically than that, a lot of people would say, well, Jeff, what do you and Andy read every day in order to stay abreast of all these different issues? Andy and I each spend about 4 to 5 hours a day reading and researching, and we'll select 1, maybe 2 articles a day that we think are uniquely valuable. And we'll use all of our social media to push that article or 2 out a day. So it's not overburdensome, because I know you have financial reading about this deep on your cadenza, and I can't do anything about that. But I can take your political and tax reading, and I do that via these social media methods. Again, it's 1 or 2 articles, and the guarantee I'll make you is that 1 or 2 article will come up in an advisor engagement or a client engagement this week, and you're going to look that much more informed than the next wholesaler. And you and I both know that sometimes that can be the difference whether you win that relationship or it goes elsewhere. So it's strictly value added, again, no charge, but you can, whatever social media you use, just follow us or join in and so forth. With that, thank you very much. I tell you, I do a lot of national sales meeting kickoffs every single year. I have to say this is the first one that I've actually gone to where the arrows are green. So congratulations. I'm very proud of AXA. I've had a long relationship with Mike Gass and your broader team as well. And it's always been a great firm that I've enjoyed my time engaged with. And I don't think you're in a better place. You have obviously a great leadership team at this point as well. So thank you. Have a great rest of your meeting and enjoy the rest of your week. Thank you, Graham.